Hello and welcome to the latest podcast on analysing financial information, and in particular we'll be looking at how to calculate the value of a business using the book value method. So you'll use this information in the valuation of the two businesses that you'll be comparing in your exam. Now for the accounting joke of the day. How did the accountant die? Because he lost his balance. Now what we're going to be looking at now in the next slide is a video on a famous Australian movie called The Castle, and where Mr. Kerrigan is actually going to get his house valued. So what I want you to do is watch the video and have a look at all the various assets that he has done to his house and how those assets will more than likely increase the value of his home.
Yeah.
John Clifton, I'm from the local council.
Is this about the dogs?
No.
The aerial?
No.
The extensions?
No, Mr. Kerrigan.
Look, if this is about my truck on the nature strip, I've had it out with you guys.
No, I'm a valuer with the local council. I'm here to do a land valuation.
What for?
Well, all properties get valued from time to time.
Oh, yeah, so you'd be able to give me a value on this?
That's my job.
That'd be good. Do you want me to show you around?
If you wouldn't mind. Yeah.
Oh, not at all. Be pleased to. Because between you and me, I reckon values around here As you can see, I've put a fair bit of work into it. Would you like me to point out the features as we go along?
If you wouldn't mind.
You see that lace up there?
Yeah?
Fake. Plastic. Gives the place a Victoriana feel. The chimney? Fake too.
Why is it there?
Charm. Adds a bit of charm. Look at the size of that aerial. That's a big aerial. What do you think? Add a bit of value?
Hard to say.
You can over-capitalise, can't you? But it's a huge aerial. And this is my backyard. Airbus, Brisbane via Sydney.
How close are you to the end of the runway?
Oh, just over the fence.
Is that the runway there?
Yeah.
There?
Beautiful machines. Sometimes you think they're going to land right on top of you. Freaks the dogs, though. Greyhounds.
Large kennel?
Well, originally it was a cubby house when the kids were growing up. I was thinking of turning it into a granny flat. The council said no.
Ah.
You know, here back, all landfill. Not allowed to build there.
Has the soil been tested?
Oh, yeah. Nothing too serious in there. What do you know about lead?
As you can see from the YouTube clip, a beautiful home with a number of assets. For example, the big chimney, the lattice work, the big backyard, and the location. Imagine the sound of the airplanes coming over every 40 minutes. Nothing better than that. Few liabilities for the house. Nothing major to worry about, just the lead poisoning in the soil. So as a valuer, you would actually look at these assets, liabilities, and then come to a figure as to what you actually think will be worth. And that is what we're going to be practicing today. Looking at the book value of a business as compared to the market value of a business. Now, to calculate the book value of the business against the purchase price, you need to follow the following formula. Subtract the total assets of the business in the statement of financial position minus the total liabilities of the business in the statement of financial position. And then you need to analyze to determine what that figure actually means. If the book value of the business is more than the market value, you're receiving a discounted price. So what that basically means is you're getting a bit of a bargain. If the book value of the business is equal to the market value, you're buying it at the market value price. So you're neither getting it at a bargain nor you're paying too much for it. And the last one, if the book value of the business is less than the market value, you are actually buying the business at a premium. So what that basically means is all of the assets in the business that they actually own, you're paying more for them than what you actually should be. So if you're going to pay more than what you should be, you need to consider the following things. The location of the business, so is it close to the target market? Is it in a busy area in which to actually attract customers? Whether they got a steady client base, whether the business is increasing in profitability over the years, and also the debt of the business as well. So we're going to be practicing now using an example. Now you're going to get a statement of financial position for a business, and more than likely it'll either have a two years variances. So you need to find the total assets. In this case, for this business, the total assets for 2020 is 313,300, and the total liabilities is 256,850. So you're going to be using those figures to determine the purchase price of the business itself. In other words, the book value. And then you compare that to what the person is offering you in which to actually sell the business to you. Now, the current business owner is offering this business for $70,000. So you need to compare that $70,000 to the book value of the business, and we calculated that as $56,150. So you can see here the book value of the business is much less than what they're actually offering. So therefore you are buying this business at a premium. In other words, you're paying way too much than what the value of the business actually is. Okay, so in doing that, you obviously need to consider a number of things, and this is what you need to discuss in your exam. The location of the business, the client base. Now we don't have any information on that, but we do have the information on the profitability and also the debt of the business. So you're going to comment on that. So the profitability of the business, as per the statement of profit or loss, is that it has declining profits of 14.25% or a minus 5.7 thousand from the previous year, and it has increasing debt of 22.27 from the year before, with an increase in accounts payable and also the mortgage on the buildings. So you can see here that this business is actually going backwards in terms of profits and increasing in debt, which is not a good outcome in which to actually purchase an existing business. So therefore you would recommend not to actually purchase the business. Now in the exam you're going to have to discuss this, and as well as look at the other investment option that you'll actually have. So if you're looking at the purchase price of this asset, in other words the existing business, you'll be looking at the return on investment that it actually has, and looking at the return on investment from the other investment, in other words the shares which you potentially could buy. And then in your evaluation you're going to discuss which one you would actually recommend with a justification. So this is your analysis part here, and this is your justification for looking at the purchase price against the book value of the business. So that ends this podcast. Good luck for the exam, and I'll calculate later.